Let's get into the advisory now and explore the reasons private wealth managers are increasing their allocation to alternative assets with James Robbins from Escala Partners, who joins me now. First time on AusBiz. Thanks for coming in, James. So what asset classes initially do you really classify here as alternative?
Well, firstly, thanks for having me. But the alternative asset classes are very vast. For us at Escala, we classify alternatives as anything being outside of your traditional stocks, bonds and cash. So we're talking private equity, venture capital, hedge funds, property, infrastructure or unlisted infrastructure, commodities, all the way down to your more exotic art, collectibles, digital assets and cryptocurrencies. Those last asset classes are particularly interesting for the younger generation and our more sophisticated clients.
Yeah, it's really interesting, the adoption particularly of crypto, and I note that BlackRock has even said, 2% allocation here. So what benefit, when you're looking more broadly at alternatives, do they bring to investment portfolios?
I think there are a number of benefits that alternatives bring to your traditional multi-asset class portfolio. As highlighted, the array of investable investment options is quite vast. Thus, the most important benefit for us is diversification. A lot of these asset classes have a very low correlation to your traditional stock and bond markets that are public. Thus, they help us in achieving a smoother risk-adjusted return over time. Another benefit that largely wholesale investors get from employing alternative investment strategies is the exclusive access to opportunities that aren't traditionally available to retail investors. So that is all in the pursuit of enhanced returns. Everyone wants to have access to or the opportunity to access the next Apple, Amazon or Google early before it lists. And that's where alternatives can be quite beneficial, especially private equity and venture capital. But also private debt in periods of low interest rates where investors are prepared to lock up portions of their investment capital. You can generate decent enhanced income-based returns whilst also having a defensive quality to your investment portfolio.
Now, you mentioned before some of the younger clients particularly interested in crypto, but more broadly, what sort of clients are attracted to alternative investments, particularly when, it used to be everybody was in 60-40 bonds and equities?
Yeah, sure. It's getting broader. Obviously, our ultra-high net worth clients at Escala have longer term horizons in terms of how they allocate for the long term. Most of it's intergenerational wealth money. So they're attracted to the space for those enhanced returns and the diversification in which they bring. So I'd say that it's important to employ alternative strategies appropriately, and that rises the importance of a investment advisor and who can leverage off a CIO team, where not all of these investments are going to go straight up and to the right.
Yeah.
Especially those more exotic asset classes. You can't just pick one and expect it to generate your next 10 bagger. So it's important employing a CIO team that are constantly performing due diligence on these investment opportunities to ensure that they are appropriately incorporated in your traditional investment portfolio outside of those traditional markets.
You mentioned before the rate environment. Now, we have had one very small interest rate cut from the RBA, and depending on which market analyst you listen to, we could be in for a couple more this year. How does that change the overall outlook for these investors?
I don't think it changes the overall outlook too much. We don't expect there'll be many interest rate cuts in Australia, even less potentially in the US. And these, looking outside of that, these alternative assets, they still provide, the opportunity for enhanced returns. They are generating returns that are in low correlation to your traditional stocks and bonds. And they're also providing hedges against inflation, which has been a topic of conversation over the last couple of years. And so we achieved that through unlisted infrastructure, property and bonds. But again, we're constructing portfolios for the long term, so these short-term moves and geopolitical uncertainties are less important and less relevant.
I assume you've been in the game for a decent amount of time. What sort of changes have you seen, particularly when you look at sort of what you were saying before about crypto and the like, in terms of how people are positioning their portfolios?
I would say with crypto, it's still a watch and see. Our more sophisticated clients with their own internal investment committees and inherent deep knowledge of the space are probably investing in that, but it's outside our realm of expertise, so we sort of steer clear of that. But
I guess I mean more broadly, what sort of changes have you seen in how people are, building their portfolios?
Well, I think the period over the last 5-10 years of low interest rates has really driven investors into alternatives, whether they be more retail mum and dad investors or your more sophisticated family office clients. They've all got the same goal, as they want to optimise their portfolio returns over time to essentially make it easier for them in retirement.
And speaking of that, what sort of long timeline do you give people with the way that they're building their portfolios and trying to position for that ultimate end of life, end of retirement pot of gold?
Mm-hmm. So we set the strategic asset allocation typically looking at a 3 to 5 year investment period. Within that period, we will tactically adjust the portfolio based on the prevailing macro environment. But when we look at investors, it's important to ascertain their unique needs, objectives, liquidity profile and risk profile before tailoring an investment strategy that best is appropriate for them. I mean, you wouldn't be putting a 80-year-old investor into digital assets or your more exotic alternative investments, but that might be quite attractive for a younger investor who has a longer period to absorb potential losses. So it's a case-by-case basis. At Escala, we are all about tailoring investment portfolios. There's no cookie-cutter approach to this.
There's a lot of focus on further regulation in financial advice space, obviously since the Royal Commission as well. What are you seeing in terms of an uptick from Australians, given there's a very low percentage of people that either seek or actually can afford potentially financial advice?
We found that we welcome regulation, firstly, but I would say that we're actually seeing an increased appetite for seeking investment advice. So I don't think that would be true of what we're experiencing.
Yeah.
But also you've got the likes of AI helping retail investors seek similar advice, but that's based on pretty rudimentary inputs into an AI model, and you're not getting that behavioural experience where someone actually understands what you're asking, whether you're asking something is correct, and ascertaining what your overall levels of risk actually are.
Do you use AI at Escala?
We are starting to incorporate AI tools, especially in our CIO team. They cover a vast range of asset classes and investment managers, and so the importance of collating all that data to spit out a investment theme or testing some of our thematics, whether they're correct. I think incorporating AI into our offering is going to be extremely helpful moving forward.